I just like to comment a little bit here, because there are hedge funds and there are hedge funds. What we're talking about are the people that do short-term trading on equity securities here primarily. And there are a whole lot of different categories of hedge funds. Something like Bridgewater, which is global macro investing, wouldn't be dealing with this kind of information at all. So they're very different people. But the short-term traders, my own experience, I ran investor relations at a major Dow 30 company for 8 years. And during that time, we considered whether we ought to spend more time talking to hedge funds, because they do move the market. They will get out and trade on even a large cap stock and ride it, because it's very liquid. They can get in and get out fast. They love it. But when you sit down with them, the one thing they always challenge you on is they want more information. They want more current information about how the quarter is doing and how the markets are doing, how your products are doing. Really trying to dig out short-term trading information, not dealing with the long-term strategic planning. Your long-term investors are always asking you about your strategy and the investments being made for new products down the road. It's a totally different psychology when you walk in the room between the two groups. And we never did go out and deal much with the hedge fund team. They obviously read our financials and traded on the stock. It's their prerogative to do that. But we never engaged them in an investor communication strategy. So just as parallel to what the kinds of things that you found.
Well, I think you raise an important point, which is there are thousands of hedge funds, and they have many different strategies, and they're not all involved in this particular type of activity, which obviously has a larger than normal sort of incidence of regulatory problems. However, in this particular sector, they're called sort of long short funds or event driven funds. It is really there is a lot of potential for problems, because basically what happens is that they're often trading around events like earnings releases. 20 years ago they used to trade on mergers and acquisitions, rumors. I mean, that sort of calmed down a little bit. But they're trying to make bets based on what a company's quarterly earnings report is going to say. And this is obviously really difficult. So IBM is going to report the end of their quarter on whatever, September 30th, and you want to be set up to make a quick profit, either long or short the stock going into the earnings report. And not only do you have to try and figure out what's going to be in the earnings report, but you have to also figure out what the market is expecting, so that you can position yourself appropriately. Because of course, if the market is expecting X and Y happens and the stock's going to go down, you need to kind of anticipate these two sets of things. And really, information that is already publicly known is in theory already priced into the stock price. So you cannot make money by just looking at public information. You need to find some proprietary either way of looking at it or little crumb, and they would often pester and hound investor relations people. And in fact, in these cases, there were many investor relations executives at different companies who got drawn into these because they ended up either giving information that they shouldn't have, or just becoming entangled and pressured by these hedge fund guys. And in some cases, the hedge fund traders were sort of offering to help the IR staff get jobs at hedge funds. I mean, there was always this sort of favor trading going on. So there was a lot of potential for abuse, and public companies, I think, increasingly have to think about the hedge fund investors, because they can have a huge impact on your stock price.
They sure can.
Well, just on a surface level, a very dramatic increase in trading volume in stock options, for example, of a stock right before some news moves the stock dramatically will often create a red flag. And there is the regulatory body called FINRA. I can't even remember what that stands for, but they're often sort of flagging suspicious trades, and then they will send referrals to the SEC or to CFTC. Sometimes it depends who might have oversight of this particular trade. And in the case of this Martoma trade, another trader at another firm noticed suspicious activity in Elan and Wyeth, the two drug stocks, and right leading up to this big medical conference where these drug results were announced. So this trader noticed this and wrote a complaint to FINRA. And of course, the crazy thing is it turned out that trader was Martin Shkreli, which I found that out later, but it's so insane. But he himself was working as a pharma trader and lost a lot of money in Elon and was very mad about it. And he saw that, someone had made a bunch of money and obviously knew something. So he wrote this angry letter to FINRA, and he didn't put his name on it, but I found this all out later. But anyway, so this anonymous trader who's really Martin Shkreli complains. And so FINRA wrote a referral to the SEC. And it's just really like a letter. And it says, a trader I think it was at RBC, noted suspicious activity and this and that, and a possible $100 million plus profit, illegal profit, and so someone at the SEC gets this letter, and they have to figure out what to do with it. And of course, one of the big problems with policing the market is that the SEC is an enormous bureaucracy riven with infighting and its own little fiefdoms. And so whoever gets this letter might not be the right person to investigate it, but they might hoard the letter or not give it to the right person. So that letter sat around for almost a year before anyone really took it up as a case. And eventually it made its way to this group in New York who were very active in investigating hedge fund insider trading. And there, fortunately, somebody wanted to kind of delve into it because it was a bit of a naughty case. There weren't a lot of details. It was going to take a lot of work to figure out if there even was a case there. And of course, they're all trying to get promoted, and they don't want to waste time on something that doesn't go anywhere. So that's always something that they have to worry about. But so the SEC started investigating, and there was a new attorney in the enforcement division who didn't have a lot to do. And his boss said, hey, just look at this, will you? SAC Capital doesn't have a very good reputation, FYI. You might want to look into this. So this guy, Charles Riley, his name is, he took it and he starts, Googling and trying to figure out and sending subpoenas. And eventually it took them more than a year to even figure out who the portfolio manager was, Matthew Martoma. They eventually figured out, by studying phone records, and, they tried to figure out who all the insiders were who were connected to those drug companies, who could have been a source of the information. They tried to figure out who at SAC Capital had done the trading. And while they're kind of piecing that together, they're having meetings with prosecutors, the criminal authorities at the U.S. Attorney's Office. This is the unit of the U.S. Attorney's Office that focuses on white-collar crime and securities fraud. And they're saying to them, we think we have a big case. We found this portfolio manager at SAC, Steve Cohen's firm, wink, wink, he has a bad reputation. You guys should look into it. You should put some criminal prosecutors on this too. There might be a criminal case here. And that also went on for months. So the clock is just ticking. And it's just an incredibly slow process. And of course, they're all juggling other cases. And eventually, they figured out who the source of the information was. It was Dr. Gilman, this doctor from Michigan. And then they start a long process of trying to convince Dr. Gilman to flip and cooperate. And that went on for another year. And, eventually they found enough of the puzzle to really get some momentum behind it. And that's when the FBI got involved, and they went down. They actually tried to flip Martoma a year before he actually was arrested, and he fainted. When they approached him, they went up to him on his lawn and they said, we want to talk to you about Elon and Wyeth at SAC in 2008, and he fainted. And, that was pretty dramatic. But they said later that as soon as he fainted, they knew he was guilty, that innocent people don't faint when they're confronted by the FBI. They get really angry and say, no way, I didn't do anything. But he just passed right out. So they knew. And a year later, he was arrested. But it's a slow, painful process. And often those cases, those investigations don't lead to dramatic fainting episodes and then charges and so on. They go nowhere. And there's incredible frustration on the part of these investigators. And, they want credit, too, for their work. Right. They feel underappreciated. It absolutely does, and honestly, the ambition level of those individuals could play into it. But the Manhattan U.S. Attorney's Office has long been considered the most prestigious, high-profile U.S. Attorney's Office in the country. The office in Manhattan tends to get all the big terrorism cases, narcotics cases, business cases, gang cases. All sorts of big, juicy trials emerge out of their work. So, but within that office, the white collar crime unit is sort of the most desirable posting for a prosecutor. And often when you come in to that U.S. Attorney's Office as a beginning prosecutor, typically you are a graduate of either Harvard Law School, Stanford Law School. They almost all in this story seem to have gone to Harvard together, including Martoma was also there at the same time as some of them, ironically. And you may have spent a few years at a big firm before coming into the U.S. Attorney's Office, and you often get put on low-level drug cases as sort of starting out. You go on this kind of rotation. And a lot of the prosecutors don't like those drug cases because they're in this position where they're sending to jail young men who are selling small amounts of drugs, and they feel, I think, a little funny about that, sending these guys away. But they do that. They have to put in their time, and they rotate through the different units. And then eventually, hopefully, they get into the white-collar unit, which is sort of the most glamorous unit there. I don't totally know why, but maybe partly because it gets a lot of press attention, what they do there. So that's partly my fault. But, they end up at the white-collar unit. So they're very ambitious, and they want to make a name for themselves. They want to bring a big case. They want it to be in the New York Times. They want their parents to read about it and, hopefully have a big trial, an opportunity to try a big case and perform in front of, the courtroom. And then the normal life cycle goes that eventually they leave and they get a job at one of these law firms doing white-collar defense work. And I certainly cannot begrudge them that because, of course, they put in all that hard work and all those years to get into Harvard Law School and to go and then to clerk for the right judges and then do the law review. And then they did all their time in the low-level drug cases, which weren't very fun. And eventually they'd like to make some more money than a government prosecutor makes. And they live in New York City. And their kids need to go to private school or whatever. And so they have to, they need to make more money. And they're also maybe sick of the grind. And they have this very valuable expertise, which is they know how the government prosecutes white-collar crime cases. So they are very valuable all of a sudden to the firms which are hired to defend white-collar criminals. And not to spoil the end of the story, but at the end of the events I describe in the book, they almost all take jobs at the exact same firms who were defending Cohen and his employees. And a lot of people who are not from the legal profession read that and reacted with complete outrage. They thought that was just corrupt. But the people who are in that field don't see it that way at all. They say, well, I've just put on a different hat and everyone's entitled to a good defense. And I think those are very valid arguments. You can't tell people where they can go seek employment. I think that would be wrong. But it does, on the surface, look corrupt.
They have a skill, though, and they're just out marketing their skill.
They have a right to get a job and to take, to whoever wants to pay him the most money. I think that's their right. But it does create this real sense of a revolving door. And a lot of people point to that as one of the reasons people don't go to jail. People even accuse them of not being aggressive as they could be when they're prosecutors because they want to curry favor with these white-collar firms where they want to seek jobs at the end. But if you ask any of them about that, they are adamant that that is not at all their intention. And I think I don't think they intend to do that. But it can lead to I think that they can over time come to identify a little bit with just culturally with those defense lawyers. I think that can certainly happen. And they all know each other and they're all sort of friendly. And some people find that, a little odd.